Okay, so you want to own a data center. You probably picture a sleek, quiet room with futuristic blue LED lights, row upon row of server racks humming softly, and a tiny team of engineers monitoring monitors while you sit back and collect sky-high monthly checks from Silicon Valley giants. It sounds like the ultimate hands-off, future-proof cash printing machine. But the global data center market is currently valued at well over $300 billion, with hyperscalers like Amazon, Microsoft, and Google pouring more than $200 billion annually into AI and cloud infrastructure. In fact, a single hyperscale campus today can consume as much electricity as a city of 80,000 homes. Yet, despite these eye-watering figures, the average independent data center operator runs on net profit margins far slimmer than you think, often under 12%, because up to 70% of total operational spend gets completely swallowed by a single line item: utility power and cooling infrastructure. Understand the brutal physics of power density and capacity utilization, and you understand this business. Miss it, and you'll go bankrupt owning one of the most in-demand assets of the 21st century. To understand why this industry is booming right now in 2026, you have to look past the obvious assumption that people just need a place to store photos and host websites. The real driver right now is the explosive shift from traditional cloud storage to high-density artificial intelligence compute workloads. A standard cloud server rack 10 years ago drew about 4 to 8 kilowatts of power. Today, an AI training cluster packed with modern GPUs demands 40 to 100 kilowatts per single rack cabinet. That means the global demand for data center floor space isn't just growing in square footage, it is compounding exponentially in power consumption. Companies cannot build these facilities fast enough, and enterprise clients are desperate for server real estate that can supply massive electrical loads without melting the building. This demand is extraordinarily durable because data is no longer a luxury or a side division of corporate enterprise. It is the fundamental utility of modern commerce. Whether the economy is booming or sitting in a deep recession, financial institutions, healthcare providers, and software platforms cannot simply turn off their servers. However, before you go out and buy a warehouse, you need to realize that not all data centers are the same business. The industry is divided into distinct segments with radically different economic profiles. First, you have hyperscale data centers. These are massive facilities built for tech titans like AWS or Microsoft, usually exceeding 100,000 square feet and drawing over 50 megawatts of power. The margins here are razor thin on a percentage basis, often around 8% to 12% net, but the absolute dollar volume is huge, secured by 15-year corporate lease agreements. Second, you have enterprise colocation, or colo. This is where you build the facility, supply the power, cooling, and physical security, and rent out individual racks or caged footprints to local businesses, regional banks, and mid-sized tech firms. Colo operators typically command gross margins between 45% and 55%, yielding net profit margins around 18% to 22%, but you assume all the sales and lease-up risk across hundreds of smaller clients. Third, there are managed services data centers, where you don't just supply space and power. You manage the actual servers, cloud migration, and cybersecurity for the client. This segment boasts high gross margins near 60%, but it carries elevated payroll expenses and liability risks. Finally, there is the emerging AI specialized hosting tier, where facilities are built specifically for dense, liquid-cooled supercomputers. This offers explosive short-term pricing power, but carries immense technology risk as hardware requirements rapidly evolve. Strip this business down to its simplest operating logic, and it sounds remarkably straightforward. You buy raw high-voltage electricity at wholesale rates, construct an ultra-reliable climate-controlled shelter, and sell that power and space back to clients at a retail markup. But the single most important lever in this entire business model is power utilization efficiency, or PUE, combined with your facility capacity occupancy rate. PUE is the ratio of total energy consumed by the building divided by the energy delivered directly to the computing equipment. An ideal PUE is 1.0, meaning every single watt goes straight to running servers. The industry average sits around 1.5, meaning for every watt used to power a server, another half watt is wasted on cooling, lighting, and power conversion. Let's walk through a concrete numeric example to see how this math actually works. Imagine you build a modest 2 megawatt co-location data center with 400 rack positions. Your fixed overhead, which includes physical security staff, property taxes, fiber backhaul lines, debt service, and basic facility maintenance, runs you $150,000 a month regardless of how many servers are plugged in. You buy wholesale electricity from the grid at 8 cents per kilowatt hour. If your facility operates at a poor PUE of 1.6 and you are only at 50% rack capacity occupancy, your power bill for the equipment plus cooling comes out to roughly $58,000 a month. Add your fixed costs, and your total monthly burn is $208,000. If you are charging clients an average of $1,000 per rack per month plus a slight power markup, you bring in just $220,000 in revenue. That leaves you with a tiny $12,000 monthly profit, a 5.4% net margin. But look at what happens when you optimize your cooling systems to bring your PUE down to 1.25 and increase your occupancy to 85%. Your revenue jumps to $374,000 a month, while your fixed costs stay completely flat at $150,000, and your variable power cost only increases proportionally with the added server load. Suddenly, your monthly net profit skyrockets from $12,000 to over $110,000. Because your structural overhead is fixed, every additional kilowatt you sell after breaking even drops almost pure profit straight to your bottom line. So, what does it actually take to get into this game in 2026? It starts with site selection, and the criteria are far stricter than standard commercial real estate. You need proximity to high-voltage electrical substations, access to redundant dark fiber optic corridors, low risk of natural disasters like floods or earthquakes, and a climate that allows for efficient ambient cooling. Licensing and zoning present a massive hurdle. Securing an industrial zoning variance is difficult enough, but the real bottleneck is grid interconnection queue approval. Electric utilities across North America and Europe are facing unprecedented grid congestion. Securing a 5 to 10 megawatt power allocation today often requires a 3 to 5 year waiting list and millions of dollars in upfront grid upgrade deposits paid directly to the utility before you even break ground. Let's break down a full, realistic startup budget for a small-scale, modern 1 megawatt Tier 3 data center designed to house approximately 200 high-density server racks. Acquiring 2 acres of properly zoned industrial land near a fiber trunk will cost around $1.2 million. Constructing a reinforced, tilt-up concrete building shell with specialized raised flooring, blast-resistant doors, and fire suppression systems comes in at $3.5 million. The electrical infrastructure, including transformers, switchgear, heavy-duty uninterrupted power supply battery banks, and diesel backup generators, will run roughly $3 million per megawatt. High-efficiency HVAC and liquid cooling chillers add another $1.8 million. Fiber optic connectivity hookups, physical biometric access control, and 24/7 camera surveillance infrastructure total $600,000. Finally, legal fees, utility queue deposits, environmental impact studies, and working capital reserve add $1.4 million. Add it all up, and your initial capital outlay for a modest, highly efficient entry-level facility sits right around $12.5 million. When you look at the revenue and profitability reality check, you have to separate corporate hype from independent reality. Giant real estate investment trusts like Digital Realty or Equinix generate billions in revenue by operating hundreds of facilities worldwide, leveraging massive purchasing power to negotiate sub-5 cent per kilowatt-hour power rates, and securing multi-decade contracts with Fortune 500 firms. As a small independent operator, you will likely start with local corporate clients, managed service providers, and regional healthcare networks. A 1 megawatt facility operating at 80% capacity can reasonably generate $2.8 million to $3.5 million in gross annual revenue. After accounting for power bills, staff salaries, site security, insurance, and equipment depreciation reserves, A well-run operation can expect a net annual profit of $500,000 to $750,000, representing a realistic cash-on-cash return of 6% to 9% once fully stabilized. However, the risk factors in this space are severe. Beyond grid interconnection delays, you face extreme technology risk. If you build a traditional air-cooled facility today, and the market shifts entirely to direct-to-chip liquid cooling for AI chips over the next 3 years, retrofitting your piping and floor loads can cost millions in unbudgeted capital expenditures. Furthermore, rising utility rates or municipal carbon taxes can instantly erode your operating margins if your client contracts don't allow you to pass those costs through directly. So, should you actually do this? If you are an individual investor with a few $1 million looking for a quick, passive income stream, the answer is a definitive no. The upfront capital intensity, technical complexity, and long utility lead times make this a brutal arena for amateurs. This business is actually suited for established commercial real estate developers, infrastructure funds, or tech entrepreneurs who can raise institutional capital, secure long-term power purchase agreements, and pre-sell at least 40% of the facility's capacity before breaking ground. Understand the physics of power, secure the grid capacity, and master capacity utilization, and you will own one of the most essential real estate assets on Earth. Miss the mark on cooling or utility contracts, and you'll be left holding a very expensive, empty concrete box that bleeds cash by the second.